Hello folks and welcome to my property market update. I'm Jason Thomson from Smartline Personal Mortgage Advisors. This week I attended a breakfast and one of the guest speakers was Rick Carr, Research Director from Heron Todd White. Rick's presentation was on the Cairns economy and the property market. Rick and the team at HTW have been doing a terrific job for quite some time now in keeping statistics on what's been happening in the Cairns property market. So I've taken this opportunity to share with you the information from Rick's talk, which is pretty much a rundown on where the economy is sitting, where that's affecting the property market, and what he thinks is going to happen during the course of this year. So let's get started. As far as the economy goes, our tourism-based economy is still plugging along. What we're seeing at the moment are reasonable numbers, getting an increase in airport passenger numbers. The difficulty that has been experienced since the GFC has been the high value of the Australian dollar. Although the numbers are holding, the spend, and hence the economic impact, hasn't been there as much. This year though, we'll be seeing new flights starting up, which will bring in direct flights from Singapore and Bali, which will be a further impetus to our connections worldwide, particularly through to Europe. Singapore has always been the missing link. The second thing has been the value of the Australian dollar. This has improved in recent times and hopefully we'll start to see the spend recover. What we're looking at in the tourism side of things certainly looks positive for the current year. Another major economic driver, and particularly in employment creation, is construction. There was a big hit on road funding, but that's just about washed through the system. Commercial construction is certainly very quiet at the moment, and there's not a lot in the pipeline. So it's really the residential side of things, which is gradually starting to pick up, which needs to be the driver. So on the construction side of things, we are looking at a better prospect than we have done. Now, the impact of that on employment. Although business activity seems to be reasonable, it's not really feeding through to strong conditions in the labour market. There are some problems with the ABS stats, but if you believe the ABS stats, you'd say that our regional employment base has been shrinking over the last 12 months. Our employment rate has been drifting a little bit higher again. It's definitely still above the state average. It's probably somewhere between the 7.5% and 8.5% level in trend terms, so it's still relatively high. There's still not a lot of confidence out there. The bottom line really is that the employment side of things is going to be a bit of a drag on the property market over the next 12 months. It's not really until employment starts to fire up again and recreates that job confidence and job security that the full impact will flow through into our property market. Having mentioned property, that's the general picture on the national situation at present. There is a diversity of markets around the country in different positions in the property market cycle. We see Cairns positioned at the start of the recovery phase and probably nudging rising market phase, which we should hit during the course of this year. Cairns, when we look at sales volumes numbers, they've certainly increased over the last 3 years. The market really bombed out in about 2011 and it's been picking up. A general rule of thumb is that the volume of property sales is roughly about 1 in 10. 1 in 10 properties seem to change hands every year, so that generates the orange line there. We're still a little bit below that level. What the agents are saying is that it's very hard to get stock. There are a lot of vendors that are sitting on their hands waiting. They've heard people telling them that the prices are going to start rising, and they've been thinking, well, we've been waiting for 5 years to sell, and another 6 months isn't going to hurt us, so we'll wait and see what happens. The volume of sales has actually been slowing off a little bit. This is to do more with the amount of stock available and the prices that vendors are willing to accept. Vendors are getting much more power in the current market cycle, or the current position in the cycle, compared to where they were. So when we look at things like prices, houses in particular, median house price has passed the peak that it was in 2007. In general terms, the median house price is now around the $400,000 mark, and prices have been gradually making their way up over the last 2 to 3 years and will continue to do so. Units are still struggling. They certainly took a hit with the GFC and B, with the body corporate insurance charge issues. There are a lot more vendors than there are buyers for units out there, and the unit prices are still fairly lackluster. They do wander up and down in the compositional mix, and similarly with vacant land prices, the median price for an allotment is now up around the 210 to 220 mark. That's increased over the last 12 months for a couple of reasons. One is the raw land price increases that have been feeding through into the system, but there's also the land on the northern beaches selling faster. Land on the northern beaches tends to be higher priced than land in the southern corridor, and so every time the market mix shifts a bit, it brings up the average because of that impact. Here you can see the experience across the Cairns market has not been uniform. Some areas of Cairns have been faster more than others, and you can see there the northern beaches has certainly picked up at a much faster rate than, say, the southern corridor. During the course of this year, we'd expect those sorts of trends to continue. For instance, in the northern beaches area and the southern corridor area will start to play a bit of catch up and the ripple effect to flow through. Vacant land sales touched rock bottom during 2011. They were at a fraction of what we'd normally expect our level of land demand to be to cater for our normal population growth and housing construction requirements. We're back up about half of the normal demand, and we've still got a way to go before we'd call it a buoyant conditions in the land market. But certainly land sales have been starting to pick up. This has been accompanied by a bit of a slow pickup in residential building approvals. House approvals are somewhere around about 40% of what's normal. Very few unit construction approvals. Aspial hasn't yet hit the statistics. At this stage, a slow increase in the building approvals, and this correlates with the land sales. On the rental side of things, the investor side of the equation, we are still seeing relatively tight rental vacancy rates. This is still reasonably good demand for rental property, and at the same time though there is a slow increases in supply through new construction and also movements from rental to ownership and vice versa. There should still be modest upward pressures on rent during the course of this year, so things should stay relatively tight. So okay, there you have it. Just to wrap up, the guys at Hare & Todd White are relatively positive about the residential property market during the course of this year. They've still got it positioned at the start of the recovery phase, but they'd expect to move that or advance that into the rising market phase as the market moves during the course of this year. Houses on the northern beaches are definitely there. Units are still struggling, so on balance, still at that start of the recovery phase. They are seeing demand increasing. The stock is reducing, although as prices rise, we should see a little more stock come back onto the market as vendors start to come out of the woodwork and prices accelerate. Limited new construction, nowhere near where we'd regard as normal housing requirements. The rental market is still tight and the affordability is there, given the prices, particularly comparative to the capital cities. We've been left behind over the last 5 years price-wise compared to the Sydney and Melbourne markets. So our attractability is the affordability and also the relatively low cost of finance with the low interest rate environment. Well, that wraps up this update. If you'd like to stay informed with property market updates going forward, make sure you like my Facebook page so you don't miss any of my future updates. Thank you for listening, and bye for now.